Good morning, venture capital. This is Metagame, and today's episode is about how the banking industry is experiencing an unexpected resurgence as cutting-edge sector analysis uncovers powerful financial trends that have been flying under the radar. Everyone's watching the AI mega rounds, Databricks, Anthropic, the billion-dollar headlines that make Twitter lose its mind. And while you're refreshing TechCrunch, something fascinating is happening in the financial services sector that nobody's talking about. Commercial banking deals just surged 22% quarter over quarter. Investing deals climbed 20%. Insurance quietly dominated with 78 deals leading all financial categories. This isn't a blip. This is a rotation. And if you're not paying attention, you're about to miss the infrastructure play hiding in plain sight. Let me set the stage. The banking industry just posted a 1.20% return on assets for the full year. Solid. Respectable. The kind of number that makes regulators sleep soundly. But Q4 net income softened to $77.7 billion, down 2% from the previous quarter. Community banks got hit harder, with net income dropping 3.8%, squeezed by non-interest expenses and securities losses. Here's where it gets interesting. That margin pressure isn't reducing deals, it's creating them. Banks are profitable enough to invest, but squeezed enough to need efficiency gains. Every basis point of expense ratio improvement matters when you're defending ROA in a softening earnings environment. That's the paradox driving this entire rotation. Commercial banking jumped from 27 deals in Q3 to 33 in Q4. That's not statistical noise. That's a sector rotating into growth mode while everyone else is worrying about rate cuts. Treasury management platforms, deposit intelligence tools, loan origination automation, compliance infrastructure. The picks and shovels that power every transaction in the economy. And the proof point? Varo Bank just closed a $123.9 million Series G led by Warburg Pincus. In this environment, for a digital bank. That tells you scaled fintech banking models still command capital, but the real action is in the B2B infrastructure, serving all banks, not just the challenger darlings. Now let's talk about the investing category, because this is where regulatory clarity becomes your alpha generator. Deals jumped from 45 in Q3 to 54 in Q4, 20% increase, and it's not happening in a vacuum. Three things converged this quarter that should have every capital markets investor paying attention. First, the SEC published its first enforcement manual update since 2017, first update in nearly a decade, and they committed to annual reviews going forward. That's a process signal for broker-dealers, RIAs, and every fintech platform operating anywhere near the securities perimeter. Second, the SEC and CFTC announced what they're calling a historic memorandum of understanding focused on coordination around lawful innovation, market integrity, and investor protection. Translation: they're watching AI deployment in trading and market structure, and they need to coordinate supervision properly. That's not a headwind. That's validation that AI in capital markets is significant enough to require cross-agency attention. Third, and this is the kicker, regulators reached consensus on a Basel III endgame reproposal, expected before the end of March. That's going to reshape bank balance sheet strategy and drive more partnering with capital markets infrastructure providers. This regulatory triplet creates sustained demand for compliance automation, surveillance tooling, market structure optimization, and risk reporting platforms. Multi-year spend cycle, not a one-quarter bump. Insurance leading with 78 deals might seem tangential to a banking and investing story, but it actually reinforces the thesis. Financial services infrastructure is having a moment across the entire stack. Insurance has been digitizing aggressively, underwriting automation, claims processing AI, embedded insurance APIs. The deal volume leadership tells you LPs are comfortable deploying capital across the whole financial services spectrum, not just narrow subsectors. Building a new product? Temez Labs takes you from napkin sketch to the App Store. Trusted by Fortune 500s for quality, security, and speed. Book your free strategy session at temez.ai. And then there's the other banking and financial services category with 43 deals. That's the connective tissue. Fintech platforms serving multiple constituencies, SMB banking plus treasury, wealth management plus lending, payments plus credit. Investors are seeking portfolio companies with optionality to serve multiple financial workflows. Lower customer acquisition costs, higher switching costs, kind of businesses that compound. Now here's where I need to connect two dots that most people are treating as separate stories. This financial services rotation isn't happening despite the AI boom. It's happening because of it. KPMG's Q4 data shows 26% of enterprises have already deployed AI agents. Average AI budgets hit $124 million. 67% of executives are calling AI spending recession-proof. Financial services is one of the highest adopters, particularly in compliance, risk, fraud detection, and customer service. Banks under margin pressure aren't cutting technology spend. They're reallocating it from legacy systems to AI-powered platforms that can automate credit underwriting, optimize deposit pricing, and streamline regulatory reporting. The community banks seeing net income drop 3.8%, they're not retreating. They're hunting for efficiency tools that can defend their ROA. On the investing side, AI is reshaping trade execution, portfolio construction, research automation, and compliance surveillance. The SEC-CFTC coordination MOU specifically mentions lawful innovation. That's regulatory speak for we're watching AI deployment in trading and market structure. That tends to increase technology spending, not decrease it, as firms invest to meet emerging standards. The $202 billion global AI funding story and the financial services rotation, same story, different headlines. AI is how financial services companies are solving margin pressure, regulatory complexity, and customer experience challenges simultaneously. So what does this mean for your portfolio? Let me give you the strategic questions you need to be asking. Are you positioned to capture the regulatory modernization cycle? The Enforcement Manual Update, the SEC-CFTC MOU, the Basel III reproposal. This is a synchronized regulatory reset that happens once per decade. Firms that help institutions navigate this complexity will see multi-year demand tailwinds. If your portfolio lacks exposure to what I'd call RegTech 2.0, you're missing the infrastructure layer beneath every financial services transaction. Can you identify which banking and investing subcategories have true pricing power? The aggregate deal increases hide significant variance. Community banks are motivated buyers, but price sensitive. Large banks are well capitalized, but have slow sales cycles. The winners will be platforms demonstrating ROI in quarters, not years, expense reduction, compliance efficiency, deposit retention. Reference customers who've already proven the model at scale. The biggest risk right now is portfolio construction mismatch. If you're overweight consumer fintech and underweight B2B financial infrastructure, you're fighting the current. The deal count acceleration is in picks and shovels, not end user apps. Second risk, missing the AI meets regulation intersection. Banks and asset managers are simultaneously dealing with AI deployment and regulatory modernization. They need platforms solving both problems at once. Pure-play AI tools without compliance integration or pure-play RegTech without AI capabilities will lose to integrated platforms. That's the competitive dynamic shaping winners and losers.
Oh, hey, friend. Do you like what you're hearing? Now you can have a ridiculously amazing podcast, too. Check out holler.studio to get yourself one today.
Where are the emerging opportunities? Deposit intelligence and treasury optimization platforms are suddenly strategic, with community banks defending margins and Basel III potentially reshaping deposit treatment. Any tool helping banks optimize their deposit mix, pricing, and stickiness becomes mission critical. Capital markets infrastructure, particularly middle and back office automation, is entering a golden age. The SEC-CFTC coordination signals more sophisticated supervision of trading, derivatives, and tokenized assets. That creates demand for surveillance, reporting, reconciliation, and audit trail platforms. Embedded finance enablers serving that other banking category represent hidden optionality. Platforms allowing non-banks to offer banking, lending, or investment services. Exactly the category benefiting from regulatory clarity and AI-powered compliance. So let me bring this back to where we started. Everyone's watching the AI mega rounds, the billion-dollar headlines, the Twitter-breaking announcements. And while that's happening, commercial banking surged 22%. Investing climbed 20%. Insurance dominated with 78 deals. A once-per-decade regulatory reset is creating multi-year tailwinds for compliance automation, risk infrastructure, and capital markets tooling. The financial services rotation isn't a sideshow to the AI story. It is the AI story, just wearing a different jersey. The smart money isn't choosing between AI and financial services. They're recognizing that financial services infrastructure is where AI delivers measurable, defensible, recession-resistant value. The question isn't whether this rotation is real. The data already answered that. The question is whether your portfolio is positioned to capture it, or whether you're still refreshing TechCrunch, waiting for the next mega-round headline while the infrastructure play compounds quietly underneath. That's our venture capital podcast for today. If you learned something new, tap 5 stars and follow our show. Thank you for listening to Metagame.
Grep News. Thomas.